those that don't know, I have written 3 books on student loans. One of them is called Take Back Control of, your student loans. So I've put a lot into those books to help people as well, just so that they can get a better understanding of what the options are. So here's some things, right, that we're going to delve into. I want to get into all of these new executive orders and postponements and regulations. So instead of putting them all on paper, we just got question marks because there's going to be a lot of details on the what do we know and what we don't know. Okay. All right. So what do we know? What we know now is that all federal direct student loans are currently on hold. Okay. There's no payments coming due until potentially after June 30th of this year. Those are only for federal direct student loans. Okay. They are not for federal FFELP loans. Those are 2 completely different types of federal loans, and I will delve into them in more detail about what the difference is so you guys can understand. But so understand that there's a postponement on all federal direct student loans until after June 30th. Now, could that extend even further? Possibly. Anything's possible at this point. We don't know. That's a we don't know side. Okay. What else do we know? We know that the government determined that there was a lot of issues with regards to their different public service loan forgiveness and loan forgiveness in general programs. And because of so much backlash, so much fraudulent handling, not just purposely fraudulent handling of student loans, the government came back upon Biden's administration taking over and said, we have to make some adjustments to eligibility because we have made lots of mistakes. Okay. What that means for people is that those that initially thought that they qualified for student loan forgiveness under public service loan forgiveness had a second opportunity to make that happen. Okay. I'm going to explain how forgiveness works as well. So we're going to get into all of that. Okay. But that's another one of these government executive orders. That's another change. We also know that because of the fraudulent handling of student loans, a lot of people's loans have moved to a new servicer. Most people think that this is their loans being sold. That's not the case. The loans are being rehandled by somebody else. Fed loan servicing contract was not re-signed, and they lost their contract to service student loans. Navient, who has been a major player in federal student loans, essentially lost their abilities, but there's always this gray area because Navient just basically changes their name once again to Advantage, same company. Essentially, they went from Sallie Mae to Navient to Advantage, but that change has happened. Mohila, not a new company in the sense that they've been around, but Mohila has now taken over as the company in charge of all federal loans that qualify for forgiveness. So anybody that says, hey, I should get public service loan forgiveness are to be moved to Mohila. So sometimes people have been moved over 3 times just in the course of the last year because their company got changed, they got moved, then the government realized they qualify for forgiveness, they got moved again. So there's been a lot of upset. Another thing that we know, the government has stated, is that Mohila, who's only been doing this for a short period of time, received a cease and desist because they were not handling student loans appropriately and purposely not staffing enough people to even take our calls and not being honest about your qualifying opportunities. Now, cease and desist isn't a proof of guilt. It's just hey, we see you're doing something wrong and we're telling you to stop it. So let's go with the word allegedly. I've been doing that. Okay. So that's another thing. There also has been some changes to the requirements for forgiveness. Under these new executive orders, those people who would have had to qualify by being in an income-driven repayment program do not have to now qualify under that program because of what's called a temporary extended public service loan forgiveness program. So what the government is saying is, hey, we realize that everybody thought as long as I'm working in public service, I get forgiveness. That wasn't the case, but it wasn't communicated effectively, because the case was that you had to both be working in public service and qualify for income-driven repayment program in order to get forgiveness. You couldn't be in deferment. You couldn't be in forbearance. You couldn't even be in a standard payment paying on time. You had to be in that particular bucket. So under temporary extended public service loan forgiveness, everybody was told, hey, you can now qualify, even if you were in forbearance, because we found that the student loan companies were purposely putting you in forbearance instead of putting you in income-driven repayment. So that's their bad. You would have qualified. Or because they never told you that that's what you had to do, that would have been a simple fix. So there's been a lot of regulation changes. And that all those regulation changes, of course, make it very confusing. Okay. So we'll jump back. We'll circle back to a lot of that here later. I want people to understand loan types. So what I talked about before about there being FFELP loans versus Department of Education loans, this is a crucial part of understanding what your options are. FFELP loans were loans that were taken out pre-October 2007. For, those of us, our age, like I think me and Kyle about the same age. I'm not sure about Cassandra, but, our age, us folks, okay? Us folks that went to school way back in the day. So those loans were still federal loans, but back then, those loans had a private lender. The lender said, hey, I'll lend the money for these federal loans, but you got to give me I don't want to call it a kickback, but you got to give me some money for doing it. Like, you got to hook me up. And the government said, cool, we're going to hook you up, but you have to follow some of these regulations. So they came to an agreement where the private lenders would lend, but it was still a federal loan backed by federal regulation. None of those loans qualify for any of this payment postponement. They don't qualify for the zero interest under COVID. They don't qualify for many of the new public service loan forgiveness programs. They don't qualify for you qualifying under the new temporary extended public service loan forgiveness program. They do not have the same options. Okay, so that's one. Now, with that being said, you can turn a FFELP loan into a Department of Education loan simply by consolidating. Easy fix. And you can consolidate one loan. It's not a refinance. It's not like you got to have two or whatever you want to call it. You don't need two loans. One loan, you can consolidate it. Now, sometimes the consolidation companies don't know what they're doing and they say you can't. And then I call and I say you can. And then they ask their manager and they find out they can't. So you might have to jump through some hoops to do it. But you can, especially in the sense that you're looking to qualify for some level of forgiveness, okay? Or just through this COVID forbearance. I mean, we've been in COVID forbearance for 3 years now? That's 3 years of zero interest. It's a lot of money. So those that haven't consolidated their old FFELP loans need to determine if it's something that they need to do ASAP. Maybe Biden gives us more time and now we get another year of zero interest. You would want to take advantage of that, even if you don't qualify for forgiveness. Zero interest is a beautiful thing, okay? Now, our Department of Ed loans are the loans that were consolidated or taken out post October 2007. These are your fixed rate loans, and they're going to qualify for payment postponement, temporary extended public service loan forgiveness, and all the other wonderful new forgiveness opportunities. Okay, the ones that were created in the past, as well as the ones that will be created in the future. And of course, the government is doing that for very specific reasons. I mean, they want to ensure that the loans are now in their hands. A little bit of control. So win-win for them. Okay. So like I mentioned, if you have FFELP loans, you really need to look at consolidating them. Now, let's delve into number 2, but I'm going to delve into it with a lot more detail. Income-driven repayment programs. People get confused about what income-driven repayment programs are. There's different ones. There's all kinds of different income-driven repayment programs. So you have your income-based repayment program, you have your income-based repayment new program, you have your pay-as-you-earn program, you have your repay program, you have your income contingent repayment program. These are all slightly different. So if you have a consolidated loan or a loan that's post, Department of Education post 2007, then ideally you would want to not go with the income contingent repayment. You're not going to necessarily want a repay program, and here's why. So what happened is they started making these repayment programs, and they didn't think it all the way through. I mean, shocker, right? Like shocker. So what happens in like the pay as you earn and the new income-based repayment program, it basically says if you have income and on your taxes as an example, and you're married, but you decide that you're going to file separately, you don't have to claim your spouse's income under an income-based repayment new program or a pay-as-you-earn program. So this is helpful in the mortgage world. If you need to drop your income for your student loans to then reduce your debt to income ratio to then qualify for a better mortgage. There's tricks. So that's one thing that's really important. So what happened in 2014 is the government said, wait a minute, all of a sudden all these people are married but filing separately. Everybody's filing separate, like, huh? So in 2014, they came out with a repay program that says, we don't care if you file separately or not. We want both incomes. But when you call the student loan company, you say, hey, I need a reduced payment. And they're like, oh, you could qualify for an income-driven repayment program. Repay will be the great one for you, but it's not. But that's a little, trick. Also with repay is that if you have graduate student loans from grad school, the percentage of the amount that you pay back is higher on those loans. So instead of it being 10% of your discretionary income, it is, oh gosh, don't quote me on it because I never even use repay anymore. I want to say it's 15% or 20, one of the two. So it's high. So you're paying a higher monthly payment amount on grad school loans under a repay program. So I always tell people not to do a repay payment program unless that's the only possible opportunity that they have, which in slight cases it may be, but it's rare. It's rare that would be their only option. Okay. So that's something. And I have noticed that even when I apply for my clients' income-driven repayment program and we ask for pay-as-you-earn, they magically get put in repay. So I'm like, that's not good. Okay. So with that being said, those are your different repayment programs. Now they come with stipulations. You can't just be like, I want an income-driven repayment program because they are income-driven. They are based on your income. And they're looking at a couple different factors. They're going to look at, of course, your adjusted gross income. They're also going to look at your family size, and they're also going to look at your total student loan balances and interest rates. Okay. And that's how it's an algorithm that they use to determine what the payment amount will be. Even if you know that your income is going to be much higher in the future, it's still worth it because the income-driven repayment programs have a cap. So if you qualify for it today, even though you don't think you're going to qualify for it in 3 years, it will never go beyond your standard payment amount. So that's a good thing.
I do have a question.
Yes.
From my understanding, and you can correct me if I'm wrong, the income-driven repayment program and income-based repayment, are those slightly two different programs? And if so, what are the differences? Or does the income-based repayment program fall underneath the income-driven? Because I did read that when I received a letter a while ago, I think it was still under Fed Loan Services because I had Navient and then it went to Fed Loan and then it went to Mohila.
Right.
And it had a breakdown of if you're in the IDR program, and they had information for that. And if you're in the income-based repayment, I was a little confused by that.
Isn't it confusing?
Is that what they mean to do? No.
So income-driven is like let's think of it like the label on the outside of the box. Income-driven repayment is the label on the outside of the box. Income-based repay, income contingent is the types inside of the program. Does that make sense?
Yes.
So income-driven encompasses everything, and then you have different types of income-driven repayment options.
So the income-driven is like the umbrella.
Yes, it's
okay.
Right. Yes. Yeah. Right. It gets confusing because people be like, I'd be like, oh, well, are you in income driven repayment program? They're like, no, I'm in the income-based repayment. I'm like, so yes. We're saying the same thing. We're just speaking a different language.
Yeah.
Yeah. So, okay. So, yeah. So that it does get confusing. There is an expectation that under the administration, there will be some level of changes to these particular programs at some point. They've already discussed it and talked about it, but we don't have like a steadfast, decision on exactly how that's going to work. All right. So those that are, do have federal loans that are currently under COVID, you can still make payments if you can afford it. If you need to take advantage of the zero interest. However, if you are looking at other aspects of your financials, it may be best, financially, if you calculate it, it will be best to take the amount that you would have paid on the student loans, and then you're going to do one of several things. If you have credit card debt, of course, you pay that down first. Then you're going to look at any other high interest rate debt that you might have. Then you're going to look at whether you're looking at investments or saving for a house, or you need a down payment, or whatever those things are. All of those should take priority because student loans are simple interest loans. They are not compound interest. Sometimes people think that they're compound interest because they capitalize. But the difference between compound interest and capitalizing interest is that in a capitalizing interest environment for student loans, it only happens during what's called a status change. So if you took your loans out in 2008 and you have been paying them every single month, you've been in a standard repayment, you haven't made any changes, you haven't decided to do a deferment, there has been no status change, you will never have interest added to your principal, okay? Never. Now, that is a rare scenario. In most cases, what happens is people go, they pay a little bit, then they're like, I can't pay this. Can I get a deferment? Okay, fine. You get a deferment for a year or 2 or 3. You go back into repayment because now you have to, and then something else happens. You're like, oh well, I guess I'll try this forbearance out. You go every single time you made a change, the interest added to your principal, and that's why people look back at their debt and they're like, why do I owe so much money? Because every single time you did something different, it capitalized. Mm-hmm. So that's why I always tell people that when you get into the meat of it, you need to have a plan and you need to know what you're doing so that you can try to stick with that plan to avoid that. Nothing is perfect. Things happen, right? COVID happens, like it is what it is. Now during COVID, again, there's no interest. So there's nothing additional that will add to the balance. But that's important to understand, right? Here's just an example of all of the different repayment options, just so that you're aware of what is available. Okay. So of course we have standard. This is your balance times your rate times your term. So your number of months. So a standard payment for a student loan would be a 10-year term, generally speaking, unless you have a consolidation and then there's something different, right? But let's just say you borrowed a loan, you didn't consolidate, you owe $10,000, you have an interest rate of 5%. You're going to be $10,000 times 5% over 120 months. That is your standard monthly payment amount. Okay. But we have some other options. So there's a graduated repayment option. So under a graduated repayment option, what this is saying is that you can make a smaller payment because now you can pay interest first over 2 years and then go back into a standard payment. So interest only for 2 years and then go into a standard payment. Okay. But keep in mind, at the end of that 2 years, what the government does to avoid your term being longer is they have to recalculate your balance, and your payment is going to be higher than what it would have been if you started day one under standard. So it's good for people potentially if, like, let's say you're taking the bar. You don't really have that much money. You haven't passed the bar. You're just going to make basic payments. But in 2 years from now, you're going to be making better money. You're okay with having a higher payment in 2 years. That would be an example of somebody that might fare okay in a graduated repayment option. Okay. Then you have an extended graduated. So an extended graduated repayment option is where you're actually extending the term options. So instead of a 10-year, let's say you owe $60,000, you can just simply ask to extend your loan to 25 years. Now it's based on balance. So $60,000 gets you 25 years. Less than that would have a lower extension term. And you can then pay interest only for 2 years. Okay. So extending the term doesn't require a consolidation. You can call now and be like, hey, I need you to extend my term. That's an option. And it's an option for those people that just simply can't pay the monthly payment that they're required to pay, but don't qualify for an income-based repayment option or pay as you earn or whatever the case may be. Okay. So that's another option. Now, we already talked briefly about these other three. So we have our income-based repayment, our pay as you earn, our revised pay as you earn. So those three, again, under the income-driven repayment program, along with income contingent. But income contingent has been around for a while. And income contingent is a little different. The only time I suggest, I won't go into every detail of it, but the only time I suggest an income contingent is generally if it's a parent plus loan. So it's a parent that borrowed money for their child. The parent is the one that's legally obligated, but they're not going to qualify for some of these other options. Income contingent might be their only best chance to get a lower payment. So they can get it graduated, they can get extended, but some of the income-based repayment, pay as you earn and so forth isn't going to match their eligibility. So that one is it's one of the lower level options that we don't want to choose unless, worst case scenario. Now, we talked about forgiveness, but more specifically public service, but I want to go into other types of forgiveness. Most people aren't as aware of these other forgiveness options, okay? So public service loan forgiveness, as you know, 10 years, you work in the public sector, nonprofit, state, government organization. You work in this sector under an income-driven repayment program, and your loans can be forgiven at the end of that time frame, okay? Doesn't have to be consecutive, but any time in between doesn't count. So let's say you worked for a nonprofit for 3 years, didn't work out, you ended up taking like a corporate job for 2 years, you came back and found another great job that you really liked for the government. You did that for, 5 years. You have 8 years towards your forgiveness. You got the 3 years that you were at the nonprofit in the beginning, and then you got the 5 years that you've been for the government. The time in between doesn't count because it wasn't not-for-profit or government or state organization. But the time still counts. So you can count the first job, you skip the second job, you can count the third job. You got 8 years, which means you got 2 years to go. Does that make sense? Yes. Okay, perfect. So that's how the public service loan forgiveness program works. Now, keep in mind, everything I'm saying to you now, there are some possible changes to all of these programs over time. And I expect that we will see changes in the next year. So we'll probably have to, go back to the drawing board. But this is how it works currently. And those that are currently in the process of qualifying for public service loan forgiveness will not be denied that opportunity, even if changes occur. Okay. So then we have the income-based forgiveness program. And not that they necessarily call it that, but they don't really have a title. So I had to give it one. They don't have a name for it. But income-based forgiveness is going to be those people that qualify. Those are the people that even FFEL loans, right? Even those old loans that qualified under income-based repayment, the old income-based repayment program, but don't work in public sector can get forgiveness in 25 years. Okay. So let's say you're working at, Costco's. Okay. You're making $30,000 a year. You got $55,000 in student loans. You're then able to reduce your student loan payment in half. In 25 years, because you won't potentially have the loans paid off, whatever the balance is left over, the government will pay. Okay. Pay as you earn is pretty much the same. The difference is this is for those people that are in the Department of Education loans, the loans that were either consolidated or dispersed after October 2007. So again, like I mentioned before, FFELP loans don't have the same options as the newer loans or the consolidated loans. So under this pay-as-you-earn forgiveness, as I call it, which also repay counts, right? Under pay-as-you-earn forgiveness, if you work for a for-profit organization and you qualify for a lower payment, in 20 years, you can still get forgiveness. Does that feel fine?
Say that
I have a
again.
question.
Sure. Go ahead, Ann.
So do you, for someone to qualify for the 25 or 20 years, did they have to be making payments though for that
Yes.
period of time?
They have to be in a repayment program. Well, let me clear up my answer. Technically, yes. In an income-based repayment or pay-as-you-earn program, if you qualify for a payment of zero, that is still considered a payment, which is confusing. But repayment, so as long as you're in, you have to be in that program. So you have to be in income-based or pay-as-you-earn. But if the government says, hey, your repayment amount is zero, that will still count. Does that make sense?
Yeah, it does. But what if, like during the time when you didn't have to pay for COVID or whatever those other extenuating circumstances, and you took advantage of that, so you didn't make the payment?
Yes,
Does that disqualify you?
you will still qualify under COVID forbearance. Yes, that's the only situation that has happened that the government is saying yes, that time still counts. So absolutely, the last 3 years that no one's been paying, they're doing COVID forbearance. That will count towards forgiveness.
Okay.
Yeah, so that's like one of the pluses of COVID. We needed a plus. I was like, oh. Yeah, so that's one of the good things. Yeah. And you have a question, Cassandra?
Yes. So how does that tie into, like with my situation, the college that I graduated from, it closed. I will say it closed. It was shut down after I graduated. And then it was taken over by International Academy, to be specific. And then it changed over to Sanford Brown, which also closed. And they actually sent me a letter saying that, any loans that I borrowed, just like the private loans, basically got forgiven. But as far as the federal loans, obviously that's a different story. But how does that tie into these programs? Because I'm having a little issue with that. And I'm not sure what type of forgiveness I would have an opportunity to get.
Look, this is about to be an exciting call for you. So let me tell you the amazing opportunities that you're about to have. So just about, I'd say a month and a half ago, a federal judge agreed that anybody that went to for-profit schools that were shut down or are on what's called the borrower defense list will get total forgiveness and a check for any money that they spent. Be on that list.
Well, okay, I have another question now. So I did read under the Department of Education that if I graduated before it shut down, that I wouldn't be eligible for full forgiveness. Has that still changed since then, or does it matter whether you graduated prior or not?
Yeah, so not necessarily. There are some weird stipulations, but here's the thing. Under the borrower defense, what it basically says is that there's the application process is horrible. It's very long. It's very lengthy. So people hire me to do it for them. It takes at least 2 hours to complete. Literally like as an expert, it takes me 2 hours to complete. So what they're looking for is for you to be able to say to them that I would not have gone to this university if I knew that they were not either accredited appropriately, that I would not do service opportunities, that they were not being forthright and honest about their job prospects or career opportunities. If you can clearly explain to them that is what has happened, that caused you to then, end up in a school that you've gotten zero benefit from, you should have an opportunity for forgiveness. The federal judge approved like $6 billion. 200 million people are going to get money. A lengthy process, but it's worth doing.
Yeah.
I mean, there's no guarantees, right? There's never a guarantee, but why not? I literally got a client. I've had 4 of them in the last 6 months that got letters. They got letters. Hey, yep, you're right. We're going to forgive your account and we owe you a check.